Welcome back to Investment 360. The potential benefits from good financial planning decisions are often difficult to quantify. Researchers at Morningstar have devised what they're calling Gamma to quantify the benefit planners can deliver to clients. In studio, we have Henry van der Venter. He's Head of Business Development at Access, to talk about Gamma in measuring a financial advisor's worth. So take us a step back and explain to us exactly what you mean by Gamma, because it sounds as though it's going to become more and more important, this term, in a low yield environment.
That's a very good point, Bronwyn. And in fact, if you look at Lisa before the break, in a world where passive investment and investment vehicles via the internet or electronic mediums has become such an easy wall to access, people now more than ever have started questioning, well, do I still need a financial advisor in the first place? And if I do need one, how do I measure if they're actually any good? The point you make is a very good one. You know, we're moving into what's likely going to be a much lower return environment over the next decade and a half. So if I'm paying 50 basis points or 1% towards my financial advice in an environment where maybe I get 6 or 7% above inflation, from my equity returns, how on earth do I justify that cost? And it's a very good question to be asking.
How do you justify the cost, and how often do active managers, I mean, this was a discussion, as you say, that I had with Lisa, how often do active managers beat the benchmark and justify their fees?
Well, it's very interesting, because if you look at the active versus passive debate, that debate broadly speaks to two different levels of portfolio management. The first is asset class specific. So if I've got a passive equity manager versus an active equity manager, is the one necessarily better than the other? And there are arguments for and against that. But the second tier revolves much more around asset allocation. If I'm going to actively manage my asset allocation, rebalance on an ongoing basis, does that add any real value? And what research has shown over time is that more than 90% of your investment risks and your investment returns is determined by your asset allocation. So whether it adds value pretty much is a no-brainer. The important question is, if I'm paying my asset manager to do that for me, or my financial advisor to do that for me.
Paying them both in some circumstances, because you'll have your financial advisor and your fund manager, and you're paying duplicate fees.
That's a very good point. But at the end of the day, it's going to be your financial advisor that's going to recommend which portfolio manager you'll be going with, how active the asset allocation mandate should be. Is it a balanced fund? Is it a managed flexible portfolio, etc.? So even though the fund managers add value at that level, we still become the final victim or beneficiary of the asset allocation advice that our financial advisors give us. And the manner in which they arrive at that advice, if you look at the traditional risk analysis questionnaires, etc., that's kind of broken in South Africa. So for us, it's a very tough situation to be in.
If you look at the discussion that I had, or listen to the discussion I had with Lisa, the global opportunity versus the local opportunity, how at Access do you balance that play when you select your fund managers? Are you looking for that global component?
I think one would be very short-sighted not to. The reality is, if you're going to look at portfolio management from a private client perspective, there are one of two ways in which you can go about it. The one is to try and optimize your returns, get the highest possible returns. There's nothing wrong with that. And if history is any indication, drop all your money in South African equities, and it's one of the best places in the world you can be. But it's not that simple. The second way in which you can manage a portfolio is to ask yourself, well, what return do I need? Do I understand that? And does my financial planning process allow me to get a very clear idea about the kind of returns I need to generate? And then the job of the portfolio manager or the financial advisor becomes managing your asset allocation in such a way that I give you the best possible chance of achieving the returns you need at the lowest possible level of risk. And if you take that approach, you've got a very different view of the world than you would have if you're just aiming at optimizing returns.
Coming back to this term Gamma, how can I hold my financial advisor accountable?
Okay, well, Gamma identifies essentially 5 key areas to look at. And it says, well, if I'm going to pay my financial advisor any money, firstly, they need to show me, and I need to understand how they're going to manage my asset allocation for me. And if they don't have a very clear, well thought through, well managed asset allocation process that they follow and adhere to for all of their clients, it's probably not a great place to be. The second area that they identify is asset location, and that speaks more about tax efficiency. So if I am a trust and I utilize different vehicles, different structures, is there a tax-free return to be made for me? And very often that's a free return that we end up getting. Your financial advisor has got to take that into account. The third consideration is annuity optimization. They did a survey in the States last year, and it's interesting. They asked retirees what they most worry about in retirement. 39% said they worry about death. 61% said, I worry about my money running out before I do. So the reality is, if you're going to look at dealing with longevity risk,
which is a huge risk that we are
absolutely.
dealing with globally at the moment.
Absolutely, Bronwyn, you could not be more right. In fact, if we look at some of the stats coming through from the Actuarial Society in South Africa, every 4 years our life expectancy increases by 1 year. So it is going to be an issue. So I can have the best constructed portfolio in the world, but if markets turn against me and my underlying strategies are wrong, have I got the benefit and the security of an underlying annuity mechanism that can kick in at some stage? And the market has evolved quite a bit as far as that's concerned. So we spoke about that's annuity optimization. The final two issues speak about your a dynamic withdrawal strategy. Also a massive issue. Not only are we moving into a lower return environment, we're also moving into an environment where we're likely to see much more volatility. Only look at South Africa this year and emerging markets over the last 5. So when I make those big withdrawals out of my portfolio, whether it be to pay for my new car, my overseas holiday, my retirement income, will have a massive impact on how long my money is going to last. And if my financial advisor doesn't have a thorough strategy to explain to me how they manage that volatility risk, there's a big issue there.
So from a financial advisor perspective, are we cleaning up the environment in South Africa, so to speak?
We are. We'll be cleaning it up a great deal more over the next 3 to 5 years. Indications are from the Financial Services Board that, as we've seen in Australia and the UK, we'll see the introduction of fee-based financial planning only, so no more commissions and rebates on investments. Your client will pay you a fee based on the value that your advisor can demonstrate.
So performance-based?
We
there's going to be an
we haven't really seen that
elsewhere.
We haven't really seen that elsewhere. So performance-based, I'd be very hesitant. But personally, and this is just me, I don't even believe the asset managers should be charging performance fees. But that's a whole different kettle of fish.
Or only performance fees. Shouldn't people only be charging performance fees?
No.
Or does that kill the industry?
No, I completely.
Because there's no performance.
Let me explain to you why. I mean, if we're going to look at the principles we touched on earlier, if my job is to achieve the highest possible returns that I can, net of costs, net of taxes, there is an argument in favour of performance fees. If my investment managers and financial advisors' job is going to be to manage my portfolio in such a way that I've got the best possible chance of achieving the returns I need at the lowest possible level of risk, performance fees speak directly against that, because it's a massive incentive for the investment managers to take on more risk, be more aggressive with asset allocation. So I'd be kind of hesitant when it comes to that. Percentage-based, we'll probably see. You know, what we're seeing in the States and Europe is...
Talk to me a bit about the current environment. And I asked Lisa earlier what she thought about the South African opportunity. She says they focus globally. What is the landscape like at the moment, and how are your clients responding to Access?
Well, what we're finding in the world of Access is financial advisors increasingly are starting to feel that maybe they're not best equipped to do all the asset allocation, portfolio construction and management themselves. So they're starting to partner with asset consulting businesses that can help them do that. And because this environment is so tough in terms of extremely volatile returns, in terms of a low return environment going forward, more advisors are sticking their hands up, and what they're now providing their clients with is a partnership. For us, it makes a great deal of sense. You know, so that's the first consideration, good place to be. The second one, we have to move away from retail cost structures. There's no way that you can continue justifying paying a fee for an asset manager at market-related prices with total expense ratios sometimes running into the 4%, plus an advisor fee of 1%, plus a ridiculous admin.
So we're going to see
platform
pressure
fee
on costs across the board.
Absolutely, and you should.
How quickly are we going to see the environment revamped?
Well,
from a cost perspective,
we're starting to see it. We're starting to see it. If you look at a lot of the major asset managers, they've completely broken with the rebate model. They're aggressively reviewing the administration fees, and that's a very good start. And more managers are starting to move away from retail products and either going passive or combining passive with a more cost-efficient in-house structure that allows them to leverage off scale in the way that pension funds does. So for consumers over the next few years, these are the questions I want to be asking my advisor. Are you charging me less for admin? If not, why not? Because it's happening in the environment.
I like that. That's very good.
Absolutely. So question number one. Question number two, Am I still paying retail prices, and if so, why? Because I can get it for less elsewhere. Am I getting active asset allocation and active asset management inside of my portfolio aligned to my interests? And if not, then probably you'll be better off going elsewhere in the next few years.